Business Editor Ross Greenwood joins me. Ross, really interesting reaction on the market. We've seen a turbocharging of the already stronger stock market today.
I'll tell you what, it's been quite something to watch, Kieran. It's been a situation where the stock market, which was already strong after that U-turn on the tax cuts in the UK, so that prompted overseas markets to rise strongly overnight. So our stock market, pretty much up until the decision of the Reserve Bank, was up around 2.5%. But since that time, it's taken another leg up. It's now up by more than 3.7%. So the ASX 200 right now, and you can see it here. You can see it at the beginning. That was the first rise, but then at 2:30, as soon as that decision was 0.25% and not 0.5%, as was anticipated, the stock market has risen literally in a straight line upwards. So the ASX 200 is up by, as we speak, around 240 points. It's a very strong day for the markets, one of the strongest it's seen in probably years. The second thing that's also happened is the Australian dollar has fallen sharply. So the Australian dollar was sitting around 66 US cents this morning, but after that decision by the Reserve Bank, the dollar has slumped down to 64.8 US cents the last time I looked a few minutes ago. And of course, this really comes off the back of, what the Reserve Bank does next and how it doesn't try and push Australia's economy into a significant downturn. And of course, that was picked up by the Treasurer, Jim Chalmers, in his press conference just a short time ago.
Well, on interest rates, I don't second guess the decisions taken by the Independent Reserve Bank. They've made it clear in their own statement today that they think that there is more work to be done by tightening interest rates. That remains to be seen, whether that's the case or not. Our own Treasury forecasts expect inflation will get worse before it gets better, but it will get better and it will moderate during the course of next year. And we certainly hope that that's the case.
What about the banks, Ross? This is what many of our viewers will be wondering. When do they start passing on these interest rate rises, the latest one?
Well, this is the interesting part about this, because it's always said there's a lag with interest rate rises, which might be another argument as to why the Reserve Bank hasn't gone as hard as what the markets anticipated today, that they're really sort of seeing the cumulative effect of having raised interest rates so rapidly from 0.1% to now 2.6%. And as a result, people with typical mortgages, I think we can show you the impact even of today's rate rise of 0.25%. It is still significant for most families. It's tens of thousands of people. For those who have borrowed millions, it's probably getting out towards $7,000 or $8,000 in a cumulative effect for those people with a typical mortgage of around $500,000. The real issue, and again, Jim Chalmers picked this up today, is that he's worried about a global recession. He says it's now not possible. It's probable that will occur, and that ultimately could hurt Australia. And of course, the real issue is you don't want to be raising interest rates in the face of a recession, because that's the time when people, mortgage holders, businesses are going to need help to make certain that as many jobs as possible can be preserved.
And I think one of the biggest things that has changed in the last month or two is the way that our expectations for the global economy have deteriorated so substantially. We had concerns for the global economy for some time now. I think the weight of opinion around the world is that the global situation has gotten much worse, even in the last few weeks. The storm clouds are gathering in the global economy, and that's not irrelevant to us as we finalise the budget.
But just to repeat, he might be worried, Kieran, about the global economy and what it's doing. Today, stock market investors are not worried, as they're celebrating with the 3.7% rise in the ASX 200 as a result of that lesser than expected rise from the Reserve Bank.